Good morning, folks. This is an introduction to mortgage notes, an investment you already understand. First of all, I'd like to introduce our organization. We are Equity Funding of Washington. We were founded in 2003 to do real estate investing and finance transactions. Principal partners are Virginia Rogers of Austin, Texas, Kathleen Davison of Phoenix, Arizona, and myself, Fred Boyd, also of Phoenix. We are careful and high service. You can reach us on our cell phones anytime. We're experienced, successful real estate investors who have, over the past several years, transitioned into mortgage notes because of the unique opportunity they represent. We are vocationally shopkeepers and educators. We sell out of our retail inventory notes that we have vetted and purchased ourselves to knowledgeable buyers that we've educated to the pros and cons of note investing. We're not brokers. You won't pay us extra fees. You won't pay us commissions. We're also not realtors. We don't shill certain investments. We're not lawyers, and we're not accountants. What that means is if you have questions about legal aspects or about tax consequences of these investments, you should check with others in your investment team. So what do you invest in now? And do you understand it? A lot of us invest in stocks or mutual funds. You know that a share of stock is a piece of a company. But do you have any idea of how big a piece of the company that is? What are your rights as a shareholder? How do you see in real detail what the company is doing that you've purchased shares in? Do you know what a 10K filing is? If you invest in mutual funds, some questions you may or may not know the answer to is, who's the current manager? How long have they been in place? What are their investment goals? You may invest in bonds. Do you know if your bonds are tax-free or taxable? Are they municipal bonds or are they corporate bonds? Invest in CDs. We know that CDs are usually issued by banks. We know that they're often insured by the FDIC. But what determines what CD yields are going to do in the future? Do you know, for instance, what the Federal Reserve will do? If you invest in insurance products, do you buy whole life or universal life? Do you know what the internal rates of return are on your investments? You probably, if you're like us, like real estate investing. But do you know how to calculate a cap rate? Do you know who you can call to manage a property that you may own that's not in your local area? Some of us invest in precious metals. We've heard that precious metals are good hedges, but if you invest in precious metals, do you take physical possession or do you leave it with a custodian? Do you invest in bullion or coins? Questions that you may understand, but you may not know why you've done investments in certain ways. And the last one, kind of a fun type of investing for a lot of us, is collectibles. Sometimes you buy these because you like the way they look. Sometimes you buy them because they're fun. Sometimes they're great investments, but how do you know these things? Chances are that the why you've purchased certain kinds of investments is somebody sold you the product. You may watch Kramer on CNN. You may watch Fox News. You certainly watch that stock ticker tape that's running across the bottom of all the time when you're watching CNN or Fox. And that's telling you implicitly that you should invest in stocks. So you go ahead and you listen, and Kramer says buy, 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 and you say where? But one of Warren Buffett's, one of the most successful investors of all times, principles of investing is that he never invests in something he doesn't understand. Now, Buffett invests primarily in stocks and companies, but he digs in and understands the business those companies are in. For that reason, he's historically never bought tech stocks. He's recently changed that and has invested in Apple in the last couple of months, but fundamentally he believes that you should understand the investment that you're making. And so if we look at pros and cons of the various investments that you may be making and contrast it with mortgage note investing, first we look at stocks and we realize, having watched the stock market go up and down over the last 20 years, that fundamentally there's no security. You can lose your entire investment. One of the nice things about stocks is it's liquid, but it's volatile. Over the long term it goes up, but over the short term it certainly can go down. Looking at bank CDs, this is sort of the gold standard of a secure investment. A lot of them FDIC insured, but low yields. Currently they're yielding 1% to 2%. And that's not current income. You get a lump sum at the end of your CD term. If you optimize your CD yield, you're going to do ladders. Those ladders will give you a lump sum every increment of time, usually every year, and then you get annual money that you can spend out of your CD investment. But these are the reasons we like mortgage notes. Number one, they are secured. They're backed by real estate, one of your fellow Americans' personal residence. They're less volatile than stocks. Certainly they can go down. But the payments are a contract between the home buyer and the person who's holding the mortgage note. We buy these notes and sell them at 6 to 10% yields. So obviously the yields are very attractive when you compare them with any of the other investments that you're looking at in today's marketplace. It's passive, monthly mailbox checks. These are checks that you can use every month to buy your peanut butter or pay your rent or pay your mortgage. Another aspect of mortgage notes is they are real-world investments. Sometimes they go sideways. Some mortgage notes can require work. Let's look a little bit more at that stock market volatility question. This is the stock market over the last year. This is the Dow average, and you can see that nobody's made any money in the market in the last year, and if you bought at the wrong time and sold at the wrong time, you could have lost a lot of money. But this is what the stock market has done over its entire history. If you bought the stock market back in 1900 something and have held it till today, you would have made a tremendous return on your investment. And over that long period of time, the average rate of return is on the order of 8%. However, if you need to sell at a time when the market is down, you're always going to risk selling very expensive stock shares. And so if you're in the stock market, you run a risk of feeling like you're riding a roller coaster with the money that you need to support your lifestyle when you're in your retirement years. We think that mortgage notes represent a unique opportunity because of the changes that have happened in the real estate and lending markets since the Great Recession. And now, understand, you already understand mortgage notes. You've played out this script. You and your significant other have had this conversation. I love this house. Let's make an offer. Can we get a mortgage? What's the monthly payment? What's the interest rate? How long will I have to pay to own this house? Can we afford the payment? What happens if we can't pay? Well, we'll have to pay, sell the house, or they foreclose, and we get locked out. So that's what you're buying when you're buying a mortgage note. Why are mortgage notes a good buy right now? Well, as I said, the Great Recession has changed the business. There are lots of houses, primarily in the Midwest, the Southeast, places that have really been hit hard by the recession, that are so cheap that banks won't do the financing. They are literally such small loans that it's not worth the regulatory hassles, the paperwork, the servicing expenses for a bank to write the mortgage. Most of these cheap houses are sold with seller financing. And many of these sellers find, after they've collected on their note for a few years, that they'd rather have a lump sum now than small monthly payments for a long time in the future. And so these sellers will sell at a discount so that we as investors can get a great yield on these mortgage notes. Now, there are also a class of notes called non-performing notes. These are notes that are not paying regularly, but these also represent a great investment opportunity and a great opportunity to do good for your fellow Americans. Non-performing notes now are being sold monthly by Fannie Mae and the other government-sponsored entities in lots of billions of dollars of unpaid balance a month. They're being sold instead of foreclosed primarily because of public relation problems that the banks have if they continue to foreclose on millions of your fellow Americans. There are millions of these loans. For banks, that represents a huge problem. It requires an institution to make lots of decisions. You as an investor are in a much better position to be able to make these decisions, and if you make them right, these non-performing notes can be a source of very inexpensive real estate. Great values. When you buy a mortgage note, you become the bank. The borrower is going to make his monthly payments to your mortgage servicing company, which is a national company that handles all the paperwork and the escrow, and then the servicing company sends you the monthly check. You never have to talk to the borrower. The borrower doesn't know your name, but the borrower pays the money to the servicing company, and then the servicing company sends you the monthly check. If there's a problem, if the borrower loses his job, if the borrower gets sick, you as the lender have the legal right to modify the note, or if no modification can be arrived at, to foreclose and take possession of the property. So these are the details of a mortgage note. They represent the terms of the repayment of the loan. It specifies the loan amount, it specifies an interest rate, the term, how long the borrower has to pay that monthly payment, what the monthly payment is, and then it's signed by the borrower, in this case the home buyer. And so here's a little cartoon with arrows of how all this works. First of all, somebody wants to sell their house. They want to sell their house for $110,000. A buyer likes their house and only has $10,000. So the buyer needs to find another $100,000 to be able to complete this transaction. Typically, if you have good credit, you'll go to a bank and get a mortgage. The buyer pays the down payment to the seller. The buyer gives the bank a note, and in return, the bank gives the buyer $100,000, which he then gives to the seller. The seller gives the deed for the property to the buyer. So the buyer is the owner now of the house. And the buyer sends monthly payments to the bank. You as an investor can give the bank a lump sum of money. The bank then gives you the note. You have the right to collect on that note, and the buyer now sends those monthly payments to you. Here's one of my friends in the note business, Joe LeCount, Rogers, Minnesota, a northwestern suburb of Minneapolis. And Joe recently bought a note on this property. This is a double-wide mobile home on land in Ocala, Florida. Joe's never been to Ocala, Florida, and it doesn't matter because Joe's not buying the real estate, he's buying the mortgage, the right to those monthly payments. Now, this collateral has a current market value of $42,000. That's important because, on the one hand, it encourages the borrower to continue to pay his note. On the other hand, if the borrower doesn't pay his note, it gives Joe an equity position that secures his mortgage. This is a performing note. The borrower is paying reliably. The property has a value of $42,000. The buyer's equity is the difference between the total value of the house and the unpaid balance of the note. The mortgage note, the original loan amount was $33,000. The interest rate on the note is 10%. Terms of the note, 240 months, and the monthly payment, $318.46. It's a first lien. That means if Joe were to ever have to foreclose, there's nobody in front of him who has a claim on the equity in the property. Joe purchased the note after the borrower had been paying for a little bit more than 3 years for $31,312. There are 203 payments remaining. And Joe bought this note with money that he had in his Roth IRA, so that every month those monthly payments will be sent to his Roth IRA. $318 as regular as clockwork. Now bear in mind, sometimes clocks stop, but this is pretty stable payment history. Those 203 payments at $318.46 represent $64,687 that will be paid into Joe's Roth IRA. The effective annual interest rate, 10%. So homeowners and borrowers, by paying their mortgage payments to anxious money investors, turn that anxious money investor into a happy retiree. Now, looking at most Americans' retirement years, we have to factor in several realities into deciding how much we need to save and how much those savings need to generate in terms of monthly cash flow. You should be anticipating that United States inflation is going to run somewhere between 2 and 10% per year. Sometimes lower, sometimes higher, but over the course of a 30-year retirement, you're likely going to have years of high inflation as well as years of low inflation. On average, Social Security pays about $16,000 a year. And those payments are inflation adjusted, so in real dollars, that Social Security check is going to have about $16,000 worth of purchasing power for the term of your retirement. 50% of Americans still have pensions, and those pensions average about $16,000 a year. Now, those of us who are still saving for retirement may not be able to count on our pensions. I, for instance, have worked my entire career and have never had access to a pension. But if you're lucky and have both pension and Social Security, that gets you about $32,000 a year. Now, the problem is, and these are averages, average monthly living expenses are from $34,000 to $56,000 a year for retirees. And the worst part of that is it's the older retirees that have the lowest monthly living expenses because they don't have the same social expenses, they don't eat out as much, and they're not traveling as much. So if you're looking at retiring at 65, you should be expecting that if your average, your monthly expenses are going to be about $56,000 a year, or between $4,000 and $5,000 a month. If you want to leave a legacy to your heirs, the average estate's about $117,000. You'd like to have a little bit of cushion that even if you live a long time, when you die, you still have something that your heirs are going to be able to enjoy. So, how do I have enough money to enjoy my retirement? For most people, that means you have to grow your monthly cash flow on the order of $2,000 a year. We like doing that through performing mortgage notes. Thank you for your attention. Other topics that we will be covering in the next few days: tax advantage investing through your self-directed IRA, performing versus non-performing notes, partials, which are buying just the front end of a performing note. These are more secure and more passive investments. Non-performing notes as your response to the mortgage crisis, and note manufacturing, selling property with seller financing. Thank you for your attention.
Fabulous.